Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris Mcintire, Mcintire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwest Ohio's resource for a common sense approach to planning for our financial and retirement future, helping to uncomplicate the money and investment world. He is Chris Mcintire, president and founder of Mcintire Retirement Services. I am Peter Rashan, and always glad to be joined by Chris, providing the insight and the guidance that Northwestern Ohio savers and investors need to build that more secure and confident financial future. That's the goal each and every day at Mcintire Retirement Services, Chris.
Yeah, it sure is, Peter. We're kind of a unique firm here. We, find our niches. We like to talk about taxes, inflation, the long-term care planning, kind of be the quarterback for the whole retirement plan there and put the team together to make it happen.
Yeah, there's a coach for the offense. There's a coach for the defense, coordinators. There's the special teams. You sort of bring that all together. You're kind of the head coach, formulating the total game plan and knowing where each piece and component is needed and utilized and vital to ultimately our financial success and the ongoing confidence that we all want to have with our money so that we can go out and live our lives without worrying each and every day and minute by minute about it. And in order to do that, we've got to have that plan in place. And that's why, ladies and gentlemen, Chris does offer for listeners to this program, for viewers of the podcast, the opportunity for that complimentary review, that strategy session. And if you would like to take part in that and get your game plan for retirement put together, pick up the phone, give Chris Mcintire a call. He's always happy to hear from listeners or viewers to the show. 800-868-1194, the number to call. That's 800-868-1194, 800-868-1194. And Chris, off air, we always sort of have a conversation about what you're hearing about, what folks are concerned about, what the show topic of the week is going to be. And we continue to hear people concerned about taxes, about fees, about inflation, about the potential for a market correction. When is that going to happen? Could it be right around the corner? All things that you help people plan and prepare for to as great an extent as possible. And even if those things do happen, to be prepared and protect ourselves against them.
Certainly, Peter. And I would say taxes have been on the forefront here as, we're watching the current administration with, these big spending bills, if you will. Some at some point they actually have to get paid for. I know that's a novel
concept, except if you are an average Joe or American household that has bills of your own, then we realize they have to be paid. The federal government doesn't seem to be living by the same set of rules.
Well, not always. And my wife even said, why are they even taxing us? If nobody's paying it back, what difference does it make? And so I'll digress on that point and move on. But I think a lot of us are, concerned that taxes at some point will go up, and that's the risk that we have within, different places where we put our monies. What are the ramifications? Sometimes those are capital gains taxes. If you have non-IRA assets and you have to sell some of them, that's a capital gains tax. If you sell assets out of your IRA account and take a big distribution, that's an income tax equation. So understanding, from the listener standpoint out there today is, it depends which bucket you take the money out of as to what tax you're going to be paying. So like right now, Peter, here at the end of the year, we're meeting with certain clients on Roth IRA conversions to take small pieces out of their IRAs and put them into a Roth IRA to maximize certain tax brackets that they're in. We're also looking for investor accounts that have non-IRA assets and then selling off if they have any losses for the year, right? Because not every stock goes up. The portfolio may be going up, but within the portfolio, you might have some assets that are down in value. And should we harvest some of those losses to offset gains at some point in the future?
So, Chris, a tax plan for every bucket. And even those buckets that it's tax-free when we pull the money out of, usually we have to pay a tax to put it in, or vice versa. And we have to understand the ramifications of the tax plan for the associated bucket in which we place our dollars.
Yeah, you're absolutely right. If the president came out tomorrow and said, hey, we're going to raise income tax rates, you would probably see people want to do Roth IRA conversions immediately, and be more concerned about their IRA dollars, where if they said we're going to raise the capital gains taxes, then you would see people sell assets out of their non-IRA pieces, if you will, and, look at paying the capital gains now versus down the road when you don't know where it's going to be. And, this isn't something that's brand new. This has happened throughout the investing history. It's, I guess if there is something new here, is so many more people are invested in the stock market, as it has become a way of American retirement planning, is, putting money in those 401ks into stocks and bonds and real estate and gold. And, when they go up in value, you have to make a reaction. When they go down in value, you'll make a reaction.
Well, Chris, they have definitely talked about, in some cases proposed, in some cases it's actually law already on the book of tax changes. And there are at least three big categories that come to mind in my mind for where they have talked about or proposed tax law changes. One of them being income tax, the income tax rates and brackets. Those may change. Capital gains, you mentioned, and then the estate tax is also something that we have heard ideas floated that could change pretty dramatically.
Yeah, no question about it. The corporate tax is one that's out there as well, which isn't necessarily part of our individual tax rates here, but that's one that they're talking about also.
Definitely affects what we pay for things, though.
Yeah, absolutely. And, because it gets passed on, obviously, if you're going to tax a corporation more, that's going to affect that corporation's price and earnings, and that'll affect their portfolio or their performance, and which will affect your portfolio, so to speak. So yeah, these things are all interrelated, and they may say, hey, we're only going to tax the rich, and that that just well, what's the definition of rich in the United States?
Anyone with money.
Yeah, anyone with money, or anybody that actually, the 50% of people that actually pay taxes. So yeah, and it's like everything else, it's got a political aspect to it as well. And Donald Trump, when he was president, cut taxes. Now we've gone through the coronavirus pandemic, and governments have had to spend an enormous amount of money, or they chose to spend an enormous amount of money on stimulus and handing money out to citizens to try to get the economy restarted. And then different administration with a different agenda, certainly, more spending from the government. And, I'm somewhat of the opinion that, put it in the hands of the people. It's better off than being in the hands of the government, because who are they ever accountable to?
Well, and opposed to previous measures of stimulus, like the quantitative easing from the Great Recession and the housing bubble, I think this time around with Corona's stimulus, they did put some portion of that in the hands of the American public. And what we did with it or do with it, that's a lot of money has actually gone into savings. The savings rate did increase during that period of time. So it's interesting what we did with a little extra money or money to get by when we were affected by that. But Chris, are you seeing that in anticipation of the proposed tax changes or the tax changes that are already on the books that will occur into the future? In anticipation and preparation of that, the proactive planners are taking action?
Yes, no question about it. And I would put us into that proactive piece there, not reactive, not waiting until the changes come, but anticipating where the changes are going to go. And, very much so in that Roth IRA conversion strategy. Because if you think about it, if you're 66 years old, for example, you're retired, and you don't have much income because you've paid everything off, you don't have debt, so you don't need $80,000 a year in income. And, a lot of instances, those folks have saved a lot of money as well. They've got, some investment success that has driven up those IRA and 401k balances. And if you have $1 million, you've got to take out roughly $1 million in your 401k when you're 72, you got to take out in the ballpark range of $40,000, about 4%. it's a, you know, a more actuarial calculation, but to use general numbers here on the show, you've got to take out $40,000. So if you're 66, why aren't you taking maybe 20,000 out? Because if your income taxes are low, converting that money into a Roth IRA where it grows tax deferred, it gets distributed income tax free, you know, to you or even your beneficiaries when you pass away. Because the last thing you want to do is pass away and then take money from your 401k and give it to your children who are in a 35% income tax bracket, right?
And in short, Chris, the reason why I think this is such a valuable consideration right now is because ultimately our goal with that money is growth. So when we achieve that goal and get growth, do we want to share it with Uncle Sam, or do we want to be separated with our partnership with the IRS in that growth?
Yeah. And it, you know, we all certainly want to, you know, pay the least amount of taxes that we're legally obligated to pay. No question about that. And so, you know, the IRS isn't going to call you up on April the 15th and say, hey, you sent a big fat check in this year. Yeah, probably some things you could have done to lessen that dollar amount. That's not how it works. You have to do the homework there. And, you know, we have a very complicated tax system here in the United States. You know, if it wasn't complicated, it wouldn't be 7,000 pages thick. You know, who's going to read that novel?
Yeah. And again, we are talking with Chris Mcintire, Mcintire Retirement Services, Northwestern Ohio, your resource for a common sense approach to planning, to be efficient with your dollars, to be effective with your plan. Pick up the phone, give a call for that complimentary review, that retirement planning strategy session. Many savers and investors across Northwestern Ohio have done a great job in building and accumulating wealth. However, the plan may just not be 100% complete. And Chris Mcintire can help you find those areas, deficiencies in the plan, places where you can leverage your money more effectively, places where you can be more efficient, keep more of your money, maybe pay less in taxes. Those are the strategies that he can help you identify in that session. Pick up the phone and give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, how has the paradigm on taxes changed? Because we had an old way of thinking, or even maybe still the waning but current way of thinking, was to build up these large tax deferred balances, a lump sum in our retirement accounts, our 401ks and IRAs, that we were delaying the payment of the tax. How has that changed? And do you think it is beneficial to continue to evaluate that way of thinking?
Yeah, great point, Peter. I would say that, you know, throughout my career here, as we look at, you know, the older clients that we have, you know, for them, they were very used to high income tax rates in the 70s and then in the early part of the 80s. We've got some of the baby boom generation now who really have much larger Roth IRA balances or Roth 401k balances. So there has been some sort of a paradigm shift in there where people are realizing that, boy, should I be paying the taxes now because it'll be tax free in my retirement, where, you know, previously, if you're 75 years old, for example, hey, you were trying to put everything in tax deferred accounts as you possibly could and pay the tax on it later, because, you know, that's when you retired, you'd be in a lower income tax bracket. Now, you know, taxes are very low, historical. It is time to rethink if what you were doing is the same thing you were doing 30 years ago. It's probably time to revisit that process. Eventually, the money is going to leave those IRA accounts. Do you want it to leave there in a lower income tax bracket or potentially a higher income tax bracket? It's a good perspective.
Another factor to consider there, Chris, is inflation. With the need for a higher amount of income just to cover the same kind of quality of life and living expenses, if we're pulling more out from our accounts today or 5 or 10 years from now, then just because we need more money, it may actually push us into higher tax brackets and paying higher tax rates. I think many people who started saving in the 80s and before probably have experienced that. A $50,000 lifestyle back in the 80s is probably at least a $100,000 plus lifestyle today.
Correct. Yeah. And just to live the same lifestyle, like you say, that's the impact of inflation. And, you know, Peter, we have talked on the show here many times where, like you said earlier in the show, people are really, focused on growth. And so, the rule of 72 says if I divide my rate of return by 72, tells me how long it'll take my money to double. So if you made 7% on your money, 7 divided by 72, it'll take you 10 years to double your money. Okay. That works the same with inflation. If inflation is 5% or 6%, to use an easy number, then in 12 years, you'll need twice as much money to buy the same things. And, I think this year with the pandemic and supply chain issues and everything that we've got, we're seeing that higher inflation, no question about it, at the grocery store, at the lumber store there previously, earlier in 2021. And, for retirees, if they're living off a fixed income like pensions and Social Security, well, that doesn't keep pace with inflation. Neither does your savings account, right?
Indeed. And one of the things that has also gone up sharply is actually the prices in the market, Chris. And maybe this is not a day-to-day kind of subsistence living expense kind of item, but for those of us that are proactive savers and investors, we've benefited from that increase in the market. However, I know a lot of people are concerned that that can't hold up forever and maybe concerned with some volatility. Now, long term, the market has gone up, and I guess we can pretty safely assume that at some time in the future and over time into the future, it will continue to go up. But do you are you talking with people who are worried about where the market is and how far it's come since maybe the bottom of the Great Recession and how much profit and progress we've made?
Yeah, I think, some of them are perpetual worriers, no question about it. But, the market continues to go up and up and up. And, is the economy really backing all of this? And, so much of this has been driven by, government spending, or, call it the handouts, the stimulus, where that money's got to go somewhere. Getting pullbacks here in the September, the October months is very common. And, we've taken a few more defensive measures with a lot of clients as well. And, kind of watering down some of the equity positions, because it's, historically or seasonally the time that would happen. And, if the markets don't go down, healthy markets correct, Peter. When they don't, then we get these inflated prices or inflated levels of the markets. And all of a sudden, you can get a real sudden pullback, and that can hurt people. If you're still working, it might not hurt you nearly as much, because if the market falls, that's a buying opportunity, right? You buy low and you sell high. When you're retired and you're pulling money out of those 401ks and IRAs, those, the sequence of returns, of negative returns hurt, because you're amplifying the losses when the market falls 20% and you pulled another 4% out for your living expenses. That's hard to recover from.
And if you're pulling that income, burning the candle at both ends. It's the market loss on one side and then the withdrawal for income on the other. And Mom used to say that's burning the candle at both ends when she used to talk to me about certain things, and I didn't understand it, but that candle is going to burn up that much quicker if you are burning it from both ends. Chris, we mentioned Roth conversions as an idea, as a strategy for those that may be worried about changes in the tax rates and brackets and environment. How about those that are worried about the potential of a market correction? What are those defensive steps or actions that are available there?
Certainly, yeah. So if you look at kind of the safe money options that are out there, if you will, you've got your traditional banking instruments, putting it into a checking or a money market account. The downside there obviously is the inflation risk. We're not getting anything for parking our money, if you will. Yeah, even the bond market can be dangerous right now, Peter, because the threat of rising interest rates, and is the interest we're gaining off of putting our money in bonds worth the risk that rates may go up at some point in the future, which pushes bond prices down. So we have to be cognizant there. Real estate is an interesting asset class because, we're not owning bonds, we're not owning stocks, we own some real estate, and there's a number of different ways to purchase it. We're not talking about a rental property across the street from yours. We're talking about commercial real estate as an investment, if you will. And can you buy stocks that handle real estate or mutual funds? It's an independent asset class. Gold, isn't necessarily a safe money strategy because it's a commodity. It goes up and down in value every single day, like stocks do. The fixed annuities can pay a set interest rate, kind of competes against what a certificate of deposit would do at the bank. And, because insurance companies aren't in the business of lending money out, they're more in the longer term aspect of buying real estate, buying bonds with their general portfolio, and then paying investors a piece of that interest that they're making off of their portfolio. Right now, you're getting a much better rate in a fixed annuity than you would be a CD, for example. And those can come in shorter terms as well. The other side of that would be like a fixed index annuity where your performance is linked to a stock market index without directly investing in it. And the insurance company takes any risk, if you will. So, you don't have any zeros or any downside risk, and your upside can be somewhat limited. But as a safe money option, if sleep is what you're looking to get, or sleep, give you some good quality nights, if you will, putting your head on the pillow and not worry about a portion of your life savings, hey, that could be a worthy strategy of consideration. And knowing all the ins and outs, and no investment is perfect. Some have some liquidity issues. So you have to be very careful on what you're looking for. But, a lot of the safer money options typically have lower fee structures or no fees, even, if you will. The trade-off would be leaving your money set for a period of time before you took it all out.
Well, it's been said you got to know when to hold them, know when to fold them, know when to walk away, know when to run. And the Vegas analogy there is that at certain times, you may want to take some winnings off of the table, so to speak. So, Chris, it sounds like there are actually varying levels with our investment strategies where we can take some of those winnings off the table, so to speak, and they don't have to simply just gather dust. We could evaluate what option for putting that protection in place is appropriate and feels right for us.
Yeah, you're exactly right. And what people's expectations are of their investment performance when the market is going up is completely the opposite when the market is going down. I think that's fair. And, it is very difficult to try to time the market. You have to build a very well diversified portfolio that supports your overall risk tolerance, right? Because, the stock market isn't a 1 year time investment. You're in this for many, many years. So if you're, building a diversified, moderate type portfolio, which is probably what most of our listeners are interested in. If we were looking at the average person, I can take 60% in stocks and 40% in other assets. All right, I'm not going to get 100% of the growth of the market, but my other assets are going to protect me when the market comes down. You may find that you end up ahead of someone who is much more aggressive because you don't have those large drawdown risk.
Chris, in the evaluation of our risk exposure with our investments, how important is that timeline? And why are some folks who may not use the money for a very long period of time or into the far distant future not shooting for maybe higher returns or willing to take the risk that would potentially result in a little higher rate of return?
Well, maybe people have had bad experiences in the past and, something has happened to them or to their parents in a lot of cases. They're bringing some emotional baggage with them, and they do make emotional decisions versus logical decisions. And, believe it or not, Peter, we deal with a lot of folks who, their money works against them, not for them in a lot of instances. So, I'm 56 years old right now, and, hopefully I have a nice long life expectancy where I'll be alive at age 86. That's 30 years from now. So if I don't have some money I can put in the long-term bucket for higher growth potential over that longer time horizon, I really got to think, why am I being that cautious? And with we can have money in a higher risk bucket. We can have some money in a medium risk bucket, and then we can also have a safe bucket. That's probably a good approach, and a good analogy to make here on the radio or the podcast.
And that approach is ultimately determined by the time horizon over which we would utilize those dollars, Chris, or should be.
Yes, no question about it. Time horizon plays a big goal in this. What do you need that money for? Somebody out here might be listening today saying, in about 3 years, we wouldn't mind buying a retirement condo or a home down in Florida, for example. Right. Well, you got to be careful with that money because you think you're going to need it in 3 years. You probably don't want to be too speculative with that. So you want to pull back on some of the conservative nature. I've got a client right now that is looking to buy another home in the Texas area, and they have extra cash that's doing nothing. So yeah, we've been putting a little bit of that into work for them very cautiously, but even in the bond market right now, they could take a hit and come out with less money in the short term than what they had put in there. So we got to be very cautious right now. This crazy low interest rate environment is challenging for all of us, folks, for us as financial advisors, and then for you as investors and savers, of course.
Once again, we are talking with Chris Mcintire, president founder of Mcintire Retirement Services, Northwestern Ohio, your resource for that common sense approach to planning, for sound advice and guidance in your investment, in your financial, in your retirement planning efforts. And to get that game plan for retirement, pick up the phone, give Mcintire Retirement Services a call, 800-868-1194. That's 800-868-1194. You just talked about the low interest rate environment. So we want our money to keep up with the cost of living. So for inflation concerns, is there any proactive strategy that if we are worried about inflation, we should be considering?
Yeah, no question about it, Peter. Inflation is one of the biggest issues we're going to have right now, in purchasing the same goods today that we can purchase 5 years from now without taking up, so much more of our assets. And that's where you have to have some money positioned that, it has the potential to grow with the pace of that inflation. Now, historically, we got rewarded for having money in savings accounts and CDs, and we do not. So, we have to look at other areas. We're personally using some real estate pieces for our clients. We're using the fixed annuities, the fixed index annuities on the safe side of things, because most people here who are sitting with money in cash right now do not want to put it back into the stock market. They may have already taken it out of the stock market, and they're looking for other places to park it, and then trying to control the taxes on if we're taking it out of the stock market, or if it's in a savings account and we put it into something, is it going to generate a bunch of taxes for them? Or, or can we put something that's tax deferred and control when the taxes get paid on it as well?
Does inflation most adversely affect a particular group? I would think that retirees in particular are at the whims and most impacted negatively and affected by inflation.
Yeah, you are exactly right there, Peter. And the reason for that is, they're on Social Security. They may have a pension that does not have a cost of living adjustment. I've said this a million times on the show here that my father-in-law is 92. He retired at age 49. He still gets the same pension payment now that he got, 50 or 43 years later.
Wow. I mean, fantastic that he can count on that income, but I'm sure that it has not kept up with its purchasing power.
Yeah, exactly. You imagine what $800 a month was, 43 years ago compared to what $800 a month does now.
Well, so this is something, Chris, that as we are working and earning a paycheck, we really need to factor into our plannings to be prepared for it when we are in and going through retirement.
Yeah, we absolutely have to have the ability to have your income increase as you go through your retirement to combat the cost of inflation, because it is out there. It's not like they send you a bill in the mail and says, hey, here's your inflation bill. You don't see that coming until you go check out at the grocery store, and all of a sudden the grocery bill that was $60 is $80, and it continues to go up from there. Ben Bernanke, when he was the chairman of the Federal Reserve, testified in Congress and said that, inflation is the same thing as a stealth tax. You never see it coming, but it's there constantly chomping away at your asset base.
Fees, taxes, inflation, the potential for market corrections and volatility, all on top of mind and large concerns for savers and investors. They are constantly, really on an ongoing basis, but maybe now more than ever. And proactive savers and investors are doing something, taking steps to address those concerns. Chris Mcintire is here as your resource, ladies and gentlemen, to help you formulate those plans, identify the opportunities to address those concerns. He does offer that complimentary review, the strategy session, and to help you formulate the game plan for retirement. If you would like to take advantage of that offer and that opportunity, similar reviews and planning strategy sessions can easily go upwards of $1,000 to several thousands of dollars. Chris Mcintire, through this program, for listeners to the radio show, for viewers of the podcast, makes it available to you with no cost, no obligation. All you need to do is take that first step. Pick up the phone right now. Give Mcintire Retirement Services a call, 800-868-1194. That's 800-868-1194. 800-868-1194. You can also visit online, McIntyreRetirementServices.com. Lots of great resources available there, but the best way to get started right now, pick up the phone and give a call, 800-868-1194. Chris, we always appreciate your guidance, perspective, and your encouragement to be proactive, to handle these matters ahead of time rather than waiting until they impact us.
It's my pleasure to be with you once again, Peter, and I hope everybody has enjoyed the show here today, and stay safe out there, folks. Thank you for listening.
Always a pleasure getting the opportunity to visit with Chris. He's looking forward to hearing from you, helping any way he can. 800-868-1194. We'll talk to you next time on Your Game Plan for Retirement.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris Mcintire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.